Okay, let's take a look at calculating overhead rates for different products. This would be similar to calculating separate overhead rates for different departments or different processes. Okay, so here we have three different products: a thick crust pizza, a thin crust pizza, and a deep dish pizza. So each one takes different kinds of materials, different amounts of labor to make each one, as well as therefore different amounts of overhead that should be applied to each type of these. So for something like a retail place that's making pizzas, but we're not talking a factory situation, we take all of our overhead costs for the month, and so we have depreciation on the pizza ovens. It's like our factory equipment, our rent for the building, our utilities for the building where we're making the pizzas, and various other actual costs of the building and equipment, etc. We're going to total all of those costs per month up. Now in here they're not doing it by the year, they're doing it just for 1 month. So the total cost is $8,000. Okay, the direct labor hours per month is approximately 800 direct labor hours per month. So to get our one predetermined overhead rate, we would take our $8,000 of overhead costs divided by our $800 of cost driver, and that gives us $10 per direct labor hour. Then we would, if we want to apply that one rate to different kinds of products, we'd have to look and see how much direct labor hour is there generally on a thick crust pizza, or a thin crust pizza, or a deep dish pizza. Now, in the previous video, we looked at a TV cabinet that was being made. Well, that was a custom TV cabinet that is going to take a different amount of every other TV cabinet. But here, a thick crust pizza, one might take 10.2 minutes and another one might take 9.8 minutes. But on the whole, they're going to take about the same amount of time to make a thick crust pizza, around 10 minutes. So rather than calculating, okay, this one took 10.2 minutes, then multiply that times our rate, okay, we're just going to come up with, okay, on average, it takes us 10 minutes to make the thick crust pizza, 6 minutes for the thin crust, and 15 minutes for the deep dish pizza. Now, this $10 overhead rate is per direct labor hour, and these are in minutes. So, how much of an hour is 10 minutes? Well, 1 hour is 60 minutes, so 10 divided by 60 is 1/6 of an hour. So for our thick crust pizza, we're going to take our rate, $10 per direct labor hour, times 1/6 of an hour that it takes us, that's 10 minutes, okay, and we get $1.66 of overhead we're going to apply to every thick crust pizza. So whatever direct materials go on that thick crust pizza, whatever direct labor goes into that thick crust pizza, and then plus we're going to put $1.66 is our estimate of overhead for that thick crust pizza. The thin crust pizza, okay, is 6 minutes. So 6 minutes divided by 60 minutes, which is 1 hour, is 1/10 of an hour. So the $10 rate times 1/10 of an hour is $1. So every thin crust pizza we're going to add $1 of overhead on top of the direct materials and the direct labor so that we know how much it cost us to make that pizza. The deep dish pizza is 15 minutes. So 15 minutes divided by 60 minutes, that's in an hour, is 1/4 of an hour. So $10 times 1/4 of an hour is $2.50. That will be applied to every deep dish pizza for overhead. Okay, as we said before, the actual overhead is debited to the overhead account as it happens. And applied overhead is credited typically at the end of every month. Sometimes if we finish the job in the middle of the month, we'll stop and apply the overhead right then so that we can, accounting-wise, move that total cost into finished goods. Okay, but other than that, we wait till the end of the month. Okay, and we look at each job. We calculate how much cost driver for each job, multiply it times the rate for that job, and credit overhead. Okay, at the end of the year, we're going to end up having the actual total debits in overhead, and we'll have the actual total credits of what we applied in overhead. And of course, they're not going to match. Our applied overhead is based on our estimates and our guesses from last fall to make that rate. So it's never going to turn out to what the actual actually turns out. So our total debits in the overhead account is never going to equal the total credits of what we applied. Okay? But hopefully we come close. Hopefully we will come close. That means that we did a pretty good job of making all our estimates and our guesses last fall when we made the formula, okay, when we made the rate, okay? If we did a really good, careful job and it comes out that what we actually had for the year is fairly close to what we estimated, and the number of cost driver, direct labor hours or whatever we're using turns out to be fairly accurate, then the difference between the debit actual and the credit applied in overhead will be fairly small. We'll take that difference at the end of the year and move it to cost of goods sold. So we're going to close out the overhead account to zero so that we can start next year fresh with a zero balance starting out. And that difference between the actual and the applied, we're just going to stick that to overhead. If the difference is large, that means we messed up when we did the estimates. We weren't taking our time, we weren't being careful, or a bunch of stuff happened during this year that we didn't foresee and caused our applied amount to be vastly different from our actual amount by the end of this year. In that case, we have a huge hassle on our hands because we have to refigure every single job. We have to refigure what the allocation should have been and go through every single job and see, how much less profit we made on each job, or if we made a loss, maybe even on each job. Whatever happens, this is a big hassle. You don't want to go there if you don't have to. So the point is, when you're the one estimating for next year, do that as carefully as you can. So in our example earlier, they showed us where the actual cost for the furniture company that got debited to overhead during the year was $102,000. And that we actually had applied, we had 8,100 direct labor hours times $1,250 that we had ended up applying all year to the jobs. And so our credit side ended up being 101,250. Okay, so now this is not too big of a difference between 102,000 and 101,250 for an entire year. That's not too big of a difference. So we can put that difference to cost of goods sold. Now, the amount that's in the debit side, our actual overhead costs, is more than our applied, the amount that we applied. So by $750. Okay, so we're going to call this over, we have more actual than what we applied. We didn't apply, as it turns out, enough. So we under applied. Okay, so here that tells us if the applied overhead is less than the actual overhead, then we under applied the overhead. If what we applied is more than what we actually had, then we over applied the overhead. Okay, those are the words that we use. Again, as long as the difference, whether it's underapplied or overapplied, as long as the difference is small, we can just move it to the cost of goods sold. Okay, again, if that difference is large, we have to reallocate overhead for the whole year to the previous jobs. This is going to require a large amount of time and effort. Okay, but if it isn't too large, we can, but it's kind of medium, we can allocate the amount to whatever's in work in process and finished goods and cost of goods sold right now. Okay, based on the balance in each of these three accounts. So if we have a large amount in finished goods and a small amount in work in process and a medium amount in cost of goods sold, then we'll take that difference from overhead and prorate it out and put the large amount of it into finished goods and the small amount of it into work in process and the medium amount of it into cost of goods sold. If it's considered a small amount, like that $750 is small compared to $100,000, okay, then all we got to do is put the whole difference, the whole $750 difference, to cost of goods sold. We don't have to worry about how much is in work in process or finished goods, etc. So here we needed to credit overhead $750 so that it would end up, the balance would be zero. Remember, the debit footing was 102,000. The credit footing was 101,250. So to bring up the debit and credit footing so they're the same and the balance will be zero, I need to credit overhead. So figure out first what you need to do to overhead to get it to be zero, and put that in your journal entry first. So here we're crediting $750 to overhead. And then the opposite is what you'll do to cost of goods sold. So here we're debiting cost of goods sold for the $750. Okay, now if the $750 was on the other side, if we had over applied, that means the 102,000 was on the credit side and the 101,250 was on the debit side, then I would need to debit the $750 to overhead, and then I would credit cost of goods sold. You want to make sure that whatever you do to overhead, by the time you get done posting it, you have a zero balance in overhead. Now, if our original cost of goods sold was $50,650, and now we have $750 added to it, we now have $51,370.